One of the most beaten down stocks in the stock market is actually Pfizer stock, ticker symbol PFE. I mean, the stock has been an absolute disaster. It's sitting at 2018 kind of levels at $35 per share. I actually did a video on the stock around $39 or $40 per share. I haven't done a valuation model, but I was looking at some metrics and I said that the stock actually looks much better than where it was in 2019, yet the stock was trading at the same price. And since then, the stock is down a decent amount. So I decided to do another quick video on Pfizer and actually talk about my valuation model this time and update you on some things with Pfizer to try to determine if Pfizer is a good buying opportunity at such prices, or maybe it's some kind of a value trap and maybe, we should wait for a better price. Now, a lot of people actually make a big mistake with Pfizer. They look at the company and they tell me, why is the company so undervalued? It's trading at 7 times earnings. There's a lot of people that told me that Pfizer is at 7 times earnings. The company is very, very undervalued. It's just too cheap to ignore, which is somewhat right, but it's actually not sitting at 7 times earnings. The company is actually sitting at 11 times earnings, and you have to look at forward earnings with Pfizer, not trailing earnings. And if you look at the forward earning picture, it paints a much different picture, than the trailing earnings. If you look at trailing earnings, the stock is sitting at all-time low, which is actually not the case. But if you look at forward earnings, it's more aligned with the historical average. The historical average for Pfizer was pretty close to 13 times, and now it's sitting at 11 times earnings, which would actually paint a very different picture. And it would show you that Pfizer is not as undervalued as you actually believe, but we're gonna dig in much, much deeper. Now, the main reason we have to look at forward earnings instead of trailing earnings is because trailing earnings in 2022, they account for massive profits because of the COVID vaccines. And now the COVID vaccines are pretty much gone. I mean, some people still do them, but it's nothing crazy like what we had in 2021 and in 2022. So this revenue is pretty much gone, and it's gonna go back to more of a historical average. Is going to drop from $37 billion to $19 billion. So this is a massive, massive drop, and it's expected to stabilize around $20 billion and slowly grow to around $21 billion by 2027. So this is one of the reasons why you have to look at forward earnings and not actually trailing earnings. But even if we look at the net income of kind of forward earnings, now the company is going to make around $19 billion of net income. Now in 2019, the company only made $16.7 billion. So now it's making much more than it did in 2019. Yet if you look where the price is at 2018 kind of levels. So it's a much better company than it was in 2019, yet the price is trading pretty much at the same exact level. And if you look at something else and you compare it to 2019, is actually the net debt for the company. The net debt was around $43.7 billion in 2019. Now it's only $16.6 billion. But there's actually a catch with this kind of net debt number. And this is because they made a recent acquisition that's not yet reflected in the balance sheet, and the acquisition is called pretty much Seagen. Most of you heard of Seagen. It's mostly around something with cancer. I'm not a pharmaceutical expert, so I don't really understand the products and the competitive advantage with Seagen, so I can't really tell what kind of potential it could bring to the company. But they are acquiring Seagen. Is going to close in the fourth quarter or the first quarter of 2024, but Seagen is expected to contribute around $10 billion in risk-adjusted revenues in 2030. Now, I'm not sure if I'm gonna actually believe that, but even if they do kind of bring in $10 billion of revenues, I don't know about the profits. And Pfizer actually got, pretty much beaten down a lot because of Seagen's acquisition, that the company is not even profitable. The company has been losing money for a while, and it's not going to be profitable pretty much before 2025. This is the soonest that analysts expect profitability from this company, and this is actually in 2025. Now, I'm not sure if whenever Pfizer acquires them and they integrate them, maybe they can speed up the process, but Pfizer did get a lot of critics for paying $43 billion for an unprofitable company like Seagen. But again, we don't know what the plans for Pfizer actually are, so we don't know how this will end up looking like, and they took on $31 billion of debt, which is not showing on the balance sheet, which is why the figure that I showed you of the net debt, it's not actually 16.6 billion, it's something like 46 billion. So it's actually back to what it was in 2019, but at least they did, get the free cash flows they got from the vaccines, they paid down some debt, and they acquired a new company with this free cash flow, which I don't believe was actually bad at all. But again, I don't know how Seagen is gonna play out. I'm not sure how this whole thing is gonna play out. I don't have any edge around pharmaceuticals, but if you trust the management team of Pfizer, and they do have a good track record in general in terms of acquisitions, this has the potential to be game-changing for the company if they can get profits out of those $10 billion. They're not talking about profits, they're only talking about revenues. And this is something that you have to pay attention to. Now, the biggest risk with the company, before I get to my valuation model, and I know you guys are going to talk about this in the comments below, Pfizer might actually get some kind of lawsuit, some kind of litigation, some kind of accusation, maybe around the COVID vaccines, or maybe around something else. This is the biggest risk with pharmaceutical companies, and there's no way to tell with any kind of certainty if this will ever happen or not. You could see what happened with 3M. The earplugs lawsuit came out of nowhere, and it's going to cost them up to $85 billion. You could see what happened with Johnson & Johnson. So the biggest risk with pharmaceutical is actually some kind of lawsuit, accusation, litigation, whatever you actually want to call them. And those tend to be very, very expensive, but they also tend to be pretty much unpredictable. So if my valuation model today is based on no litigation, no kind of big lawsuit or anything major, but if they do have some kind of a lawsuit 2 or 3 days from now, and it's around $50 billion, you bet that Pfizer is going to go down another 10 to 15% from here. So I really don't know what could happen, but this valuation model is based off a neutral kind of environment. If nothing pretty much changes around the normal, if everything stays the same, this is what my valuation model is based on. And Pfizer themselves, they are guiding a 32% decline in revenues for 2023. So this is what I put in, and then I just put in 1% revenue growth from 2024 to 2027. I'm not sure how Seagen is going to influence this, but I put in 1% because they're not going to bring in any profits from Seagen anytime soon. So I believe 1% for revenue growth is actually fair. Net income margin 30%. I kept it at 13%. Now the PE ratio right now is 11, but the historical average has been close to 13. So I did include a multiple expansion for Pfizer from 11 to 13, which I personally don't believe is something that's over exaggerating or something crazy. I think this is something that's very, very fair for the company, especially if they can actually prove that the Seagen acquisition is going to be profitable by 2027. Now there's a lot of uncertainty, and this is one of the reasons why the PE ratio is down. But I personally believe if they can actually prove that this acquisition was a good acquisition, was a good decision, then Pfizer can get a multiple expansion to 13 times earnings and even maybe to 15 times earnings 5 years out. And here I put in a 6% dividend. Not all of it is a dividend. It's 1.5% buybacks because the company tends to buy back 1.5% of their shares outstanding every single year. And I put in around 4.5% for a dividend because this is a current dividend with Pfizer. A lot of dividend investors actually like Pfizer because they have stable and growing dividends. They have been growing those dividends since 2010. They don't actually grow them very fast at all, but the payout ratio is low. The company does buybacks. It's in the pharmaceutical, pretty safe industry, and they actually, do increase the dividends. It's not a crazy pace, but it's, 4.5%, which is not bad at all. Now, the total upside in this valuation model was 68%, or pretty close to 11%, compounded every single year for the next 5 years. And I don't think this is a bad return at all for the kind of risks that you're taking. I think this is a pretty safe return. Now, if I want to double my money with Pfizer over the next 5 years, I would have to buy Pfizer around $29.85 per share, around $30 per share. Now, $30 per share is somewhere where it was trading at, somewhere around the COVID lows. So I'm not sure if Pfizer is actually going there. I personally don't believe Pfizer is going there unless they get some kind of a huge unexpected lawsuit that sends it, way down. But the company for me does look fairly valued, but you have to keep in mind that there's no near-term catalyst. There's nothing that could, cause some kind of a massive appreciation in the price unless they get some kind of a vaccine or some kind of a product that's unexpected or something crazy with their clinical trials, which I personally don't understand. But looking at the numbers, I don't see any kind of near-term catalyst for Pfizer, but I do believe the company does look fairly valued. It's not extremely undervalued. So I was a little bit wrong in my video before. I believe once I did my valuation model, around $30 per share or somewhere close to 30, I believe the company could be an amazing buying opportunity. So thank you for watching this video. I hope you enjoyed it. If you did, please press the like button and maybe consider subscribing. So I hope to see you in another video.